Good morning and welcome to the 5th Annual Stakeholder Day for CDC. Thank you for bearing with us with some minor technical issues we had at the beginning there. It wouldn't be the same in COVID without some technical issues. I'm Lynsay Taffe, I'm Director of Communications here at CDC, and I'm going to be guiding you through the event that we have today, which is of course all about presenting CDC's annual results and sharing some of the progress and the successes and the challenges we faced over the past year. And speaking of challenges, the title and the theme for this year's annual review is Rising to the Challenge. And that's been a goal that's been faced by not just CDC, but countless organisations and individuals over the past year as they've dealt with the catastrophic fallout from the pandemic. And as a DFI, alongside this, we've also seen that the issues that we deal with year in, year out have been thrown into an even sharper focus. So jobs and access to goods and services for the poorest people, women's economic opportunities, and of course, the climate crisis. And it is that gives us our agenda for today. We'll be looking at our annual results, COVID, and our impact on people and planet. So, for today's agenda, first up we have our chairman, Sir Graham Wrigley, who's joining us for his last ever annual Stakeholder Day as he steps down at the end of this year as our chairman after 8 remarkable years with the organisation. Now today's not about that, but Graham will give us a little update on the process for succession at the very end of today's event. He will then hand over to our CEO, Nick O'Donoghue, who will be joined by a host of CDC colleagues who will present our annual results and in this section delve a little further into what we've been doing to respond to COVID-19. And then it's back to me where I'll be joined with Nick and Graham for a no questions barred Q&A. As in other years, you can ask anything you like. Please submit your questions in the Q&A at the bottom of the screen and we will do our very best to get through as many of them as we can. And of course, we have around about 500 people with us online today, so I will do my very best to get through as many of them as we possibly can. So after the Q&A, we'll take a short break, but don't go too far. We'll then have 2 panel sessions where we look at our impact on people and planet. And I'm really excited about these panel sessions because we've got 4 of our investees joining us. We have LoadShare, Cash Foundation, Reserve and Greenlight Planet, and they'll be telling us a lot about the fantastic work that they've been doing with our support over the past year. So I hope you agree, we've got a great agenda, so let's get started. I'll hand you over to our chairman, Sir Graham Wrigley, but first, a short film.
Thank you, Lynsay, and thank you to Lord Collins, as it was his suggestion during the CDC Act back in 2016-17 that we started this tradition. And everyone, to reiterate what Lynsay said, please do send in your questions. We really want this to be an interactive day. Let me start with COVID. Though we might be nearing the end of the current phase in the UK, we're very conscious that the worst may still be ahead in South Asia and Africa, not only from a health perspective, but also economically. We think that this aspect of COVID has not been fully appreciated. Whilst the global north has provided stimulus on a massive scale to combat the effect of COVID, money has been leaving the global south. For example, FDI to Africa fell in 2020 by about 20% to 40 billion. This is a continent of 1.2 billion people. Contrast this with the US government's $2 trillion package for a population of 330 million. There are no proper furlough schemes in countries like Kenya or Pakistan. So private sector companies providing jobs and paying taxes are vital to these countries, and therefore CDC's long-term patient capital is even more important at this time. At the April 2020 board meeting, the CDC board and management team committed to give the very best counter-cyclical response to COVID, yet at the same time remaining long-term stewards for CDC by delivering on our 5-year strategy commitments. Today, Nick and his team will report on both our COVID response and our delivery on our other strategic commitments. But with an annual commitment in 2020 of £1.2 billion, at a time when capital retreated from Africa and South Asia, we've provided much needed, impact-driven, targeted capital and liquidity to our partners on the ground. And I salute the team, and I'm really proud of all that they did. To achieve this, we needed both a rapid new approach in the most challenging times, and the management's tireless work has had an impact, as I know from multiple interactions with our partners on the ground and in Africa and South Asia. Of course, not everything has gone to plan. Lord Reith's description of CDC's mission is always in our minds, doing good without losing money. And so we were disappointed to have suffered a loss last year. Whilst we have signalled very clearly for many years that our returns will come down, and all the major DFIs had similar losses last year, I want to reassure you that everyone at CDC is very committed to keep on meeting the long-term financial target agreed with our shareholder. Before Nick and Carolyn, our great new CFO, go into more details, I wanted to briefly cover 3 more longer-term and strategic topics that I'm often asked about during the year. The breadth of CDC's investment mandate, CDC's institutional capabilities, and CDC's relations with our shareholder. Hopefully these will provide some useful context for the day. Everyone who cares about development has an opinion on the focus of CDC's investment mandate, and that's great, though often their views are very different. Some are frustrated that we aren't working more at scale to mobilise billions of capitals. Others want us to focus exclusively on small $1 million investments in fragile states. The reality is that economic development takes decades, and CDC should be a partner for countries and their private sectors as they progress up the escalator of economic development. This slide, which is taken from our 2017 to 21 strategy document, shows how we've tried to tailor our offering for countries' differing needs. As you can see on the left, you might have a country like DRC, where deal sizes are very small. The need for our capital, additionality, is without doubt, but mobilization is almost impossible. On the right-hand side, in a country like South Africa, the ability and the imperative to work at scale is real. What we look for and what we contribute, therefore, varies over time and by country. Of course, this brings complexity. We need to provide capitals at both ends of the spectrum, ranging from $1 million investments to hundreds of millions of dollars. And this slide shows some examples of how we're trying to do this today as we build up a balanced portfolio. To cover the smaller end of the spectrum, we can't make hundreds of small investments directly from London, so we tend to work with partners who buy into our approach. We call this intermediary approach. For example, in trade finance, the average guarantee of our commitments last year was $1.2 million, and the smallest trade just $6. Through funds, CDC has $1 billion invested in 432 SMEs. In 2020, 1/3 of the investments in this program were under $1 million in size. At the other end of the spectrum, back in 2016, CDC created a renewable energy company in India called IANA, completely from scratch. We recruited the team, created the company, even designed the name. And we've committed $157 million. Since then, we've raised $600 million of funding, and it's on its way to being a 5 gigawatt business providing clean energy for millions. And that will need $7 billion. Liquid telecom, building the digital infrastructure for Africa, and the recent investment to Ethiopia, the Safaricom. These are great examples of us operating at scale. These last investments get more headlines, but a lot of the daily work of the CDC teams are on companies you won't have heard of. The second theme I wanted to talk about was CDC's progress as an institution. As you know, CDC operates in 5-year strategy cycles, and over the last 2 strategy periods, from 2012 and 2017, CDC will have committed about $12 billion in long-term, impactful investments in some of the hardest geographies of the world. And CDC's investment mandate's the hardest I've ever had to work on during my professional career. To achieve this has taken huge effort from the management team, but also significant investment in CDC as an institution. We've gone from a single product business, funds, to a multi-product business, debt, equity, infrastructure, microfinance, and of course funds. From 1 office to 13 offices, 61 people to 486, 4 impact professionals to 74, from committing about $300 million a year to around $2 billion per annum. Finally, this year, we've also achieved 50% gender diversity at the board, which we're really, really proud about. Beneath the bonnet of CDC, we now have formal independent investment committees for each product, a risk and management function, independent audits, internship programs to recruit talent, diversity groups, and so on. And of course, all of this is underpinned by the extraordinary team, the people we have at CDC. There is more to do, but I want to assure you all that the board and management are very focused to keep on nurturing our human capital and capabilities in an organisation, a goal that is indeed enshrined in our Articles of Association, so that we can continue to deliver our mandate and to deliver what we know will be a new set of ambitious targets for our shareholder in the next 5-year strategy. That leads us on to my final point, CDC's relationship with our shareholder. We are proud to be 100% owned by the UK government and to be the UK's development finance institution, the first in the world. There has, of course, been a change in our reporting lines this year, and we now report into the Foreign Secretary and FCDO. We're extremely grateful for the commitment and support the DFID, Secretaries of State, Ministers and officials gave us over the years. All that we have done would not have been possible without them, and the CDC Act of 2017 is a lasting legacy. I would also like to give our thanks to FCDO. I'm very aware that CDC can bring many challenges. CDC is such a long-term business where an investment can take a decade to prove success, but in the meantime give many years of worrying and risk and sleepless nights along the journey. The Foreign Secretary, the Minister for Africa, and all the other ministerial teams and officials have been very supportive during this merger and the challenging times of COVID, and for that I'm personally very grateful. Of course, we're also acutely aware that the shareholder and many others, some of you on this stakeholder call today, are rightly pushing us to carry on improving and think we can do better. Whether it's Parliament, the Public Accounts Committee, the Select Committee, ICAI or civil society, we always honestly listen to ways to improve. And when there is some praise, we find that very motivating. So we were delighted last month, when ICAI published a report that pointed to CDC as an example of a positive learning journey that brought about strong results and impressive improvements, and praised us for how closely we work with the ICAI team. Thank you to the ICAI team for all the effort you put in. So by the end of today's annual review, I hope you see that everyone at CDC is driven to make a positive impact on poor people's lives in Africa and Asia and to help tackle climate change. And we want to make all our stakeholders, including, of course, the UK taxpayer, proud of the work that we're doing on their behalf. Thank you.
Thank you very much, Graham. Actually, a really helpful reminder that CDC's response over the last year has actually been embedded in a long-term vision and mandate and build-up of the organisation for nearly a decade. Can I please remind you to keep on adding questions to the Q&A to prepare for the session that's coming up just after this next one. And this next session is where we'll delve a little further into our annual results and look at the response to the COVID-19 pandemic. And I'm delighted now to introduce our CEO, Nick O'Donoghue.
Well, good morning, everybody. It's a real pleasure to be here. It's great to have all of you online and listening to us. This is my fourth annual review as the Chief Executive of CDC. And as I reflected on previous years, I realized that my remarks have always been focused on how we're moving forward, how we're growing, how we're improving what we do. And I think Graham's touched on the significant progress that's been made in terms of growing the firm and ensuring that we can understand and articulate the impact we've been making. But as I stand here today and I reflect on 2020, it's been a year like no other. It's been a tough year for everybody, personally, professionally. Globally, it's been challenging from a health and economic perspective. We've had a devastating health emergency, which has cost over 4 million lives. We've had the economic impact of the pandemic, which has been more severe and broad-based than the global financial crisis, and probably the worst that we've seen since the Great Depression. We've pushed, or the pandemic has pushed around 2% of the global population. That's 140 million people, most of whom live in CDC's geographies, into extreme poverty. And the FCDO, our shareholder, predicts that the pandemic has reversed progress on fighting world poverty by as much as 7 years. And of course, as Graham mentioned, it's been particularly profound in many of the countries where we invest, where there isn't the same level of fiscal support for the private sector that we see here in the UK. So what's all that meant if you're a development finance institution, and specifically what's it meant for CDC? Well, like every other organization, we've had to adjust the way that we do business. And at CDC today, you work from home. You're presented from traveling, which makes building relationships, doing due diligence, and monitoring the impact that you're creating more challenging. And you rely even more heavily on locally based staff and consultants. But overall, I have to say I'm very proud of how quickly and effectively CDC and its people have adjusted to that new way of working. But of course, we're a development finance institution, and DFIs have a role that goes beyond just keeping their own business going. And our role is to provide capital to private companies, to help them grow, to help create employment, to help generate the tax base that helps support the provision of critical public services like health and education. We're meant to be additional. We're meant to fill gaps where commercial capital is unwilling to go. But of course, the problem in a financial crisis and an economic crisis like the one we're going through is that those gaps become much larger as mainstream capital providers become more risk averse and government budgets are stretched. And of course, that's a particular issue in less developed countries that lack their own domestic capital markets and where governments, unlike in the UK, don't have the wherewithal to provide additional funding. So what does all that mean for employers and companies operating in those environments? It means shortages of working capital. It means a lack of trade finance. It means less availability of credit. And so what are the consequences of all of those things in the real world for real people? Well, job losses and unemployment, a shortage of critical goods and services, lower tax revenues, reductions in public services, and more people living in poverty. And those consequences happen everywhere, including here in the UK, but they particularly happen in our geographies. So as other sources of capital step back, development finance institutions need to step forward. And we need to be counter-cyclical. And indeed, our role at these times, during these crises, is vital. And I'm proud to say, as I reflect on 2020, and as I think you're going to hear from my colleagues, we did step forward. And we knew if we were to make a difference, we needed to act with speed, we needed to act with scale, and with simplicity. And Yasemin will talk shortly about how we pivoted directly to respond to COVID, with additional liquidity support, with more technical assistance, with support to health systems, and with extra funding to help kickstart a sustainable recovery. And of course, as we did that, we also benefited from all the work done in previous years to strengthen CDC as an organization. And that's helped us to react quickly and effectively. So the diversified investment products that Graham mentioned that provide long-term solutions across the capital structure to growing companies. All the hard work we've put into embedding development impact more effectively into our investment process to ensure that we learn from what we're doing so we can change and adapt to support even greater impact. Our ability to provide technical assistance through CDC Plus, who were able to provide assistance to over 70 companies. The strong relationships we've built in local markets, both with the local private sector and with our FCDO partners. And indeed, we've benefited enormously from having more staff on the ground, from almost no staff outside the UK in 2017 to 16% of our staff in Africa and South Asia today. And I have to say that their efforts, despite the significant health challenges in their own home countries, have really been critical to our ability to operate effectively in 2020. So our purpose today is to launch the annual review. We called our annual review, as Lynsay said, rising to the challenge for a reason. And I think if you take time, which I hope you will, to read it, you'll see a whole range of examples where CDC in this extraordinarily difficult environment is making a difference. You'll have the opportunity to read about MedAccess. MedAccess is a subsidiary of CDC. It provides innovative social finance that enables life-changing medical supplies to reach people in Africa and Asia. You'll read how they responded rapidly to the pandemic and resulting in a $50 million guarantee to support UNICEF to secure vital COVID-19 medical supplies. And that's really innovative finance at work. And you'll also have the chance to read about M-Pharma. M-Pharma is a Ghanaian healthcare company that uses data and technology to help make the medical supply chain more efficient and help reduce the cost of medicines. And they found ways, with our support, to distribute over 1 million testing kits to medical labs in 5 African companies. And later you're going to hear directly from another of our investee companies, LoadShare. LoadShare is a logistics company. It's based in India. It reaches local suppliers and rural customers. The company has over 6,000 contractors on its platform, and it's been able during the pandemic to shift its business model to retain its workforce. And so there are many other examples like that in our annual review, and so I really encourage you to take the time to read it. But of course, CDC is a development finance institution, and that means that we have to be more than just an investment institution. So you shouldn't judge us by how many new investments we make, how much money we can deploy, what the return is, or even the individual impact that any one of these projects have. I mean, these are all important metrics, but ultimately we need to be judged on all the things that we do to try to make a difference to people's lives in our geography. So for instance, you should judge us on how we collaborate with other development and commercial institutions to mobilize more than just our own capital. And we've done that. Most recently, we were really proud of the leadership position we took alongside FCDO to orchestrate a commitment at the G7 meeting from the G7 DFIs and other multilateral development banks to commit over $80 billion to the private sector over the next 5 years to support sustainable economic recovery and growth in Africa. That's going to make a huge difference for Africa. And we also this year co-sponsored for the 3rd year with the IFC, the Fragility Forum in Oxford with Sir Paul Collier, which brings together the development finance community to coordinate more investment in the most fragile and conflict-affected states. And we should also be judged on other things. Do we, for example, move the needle to address the gross underrepresentation of women-led businesses and businesses focused on serving women? Because that probably has more of a drag on development than almost any other issue. And CDC was a co-founder of the 2X Challenge 4 years ago. That initially targeted $3 billion for gender-focused businesses over 3 years. It delivered $7 billion, and the new target is $15 billion. And I was particularly proud last week at the Gender Equality Conference in Paris, which was sponsored by the French government and the UN, to be able to personally launch the new 2X Collaborative, which will extend 2X to a broad range of commercial investors. It'll lead in the development and harmonization of metrics and standards, and it's going to ensure that a gender lens is included in all investment decision making, including, of course, our own. And this initiative, led brilliantly at CDC by Jen Braswell, will make more difference than almost anything else that we do, and certainly more than any other single investment. And you know, in a world where the single greatest challenge facing the world is climate change, we should be judged on our climate policy. And DFIs have a key role to play in addressing the climate emergency, especially in poorer countries. We need to play a lead role in the transition from fossil fuels to renewables, and we need to ensure that that transition is a just one. We need to recognize that our geographies and the people who live there are the most vulnerable to climate change, and they will need support to become more resilient and to adapt to the inevitable changes that global warming will bring. And yes, we also need to remember that 650 million people in Africa still lack access to reliable power on a continent that generates less than 2% of global emissions. And without that access to power, economic and social development is almost impossible. So you'll hear shortly from my colleague, Yasemin, on the launch of our climate strategy last year, what we think we've achieved against the strategy so far, and again about our leadership position among other development finance institutions and MDBs in investing for climate mitigation, adaptation and resilience, and a just transition. And if COVID has demonstrated one thing, it's the importance of access to the digital economy. So you should judge us also, us and all the development organizations, on what we're doing to both build a digital infrastructure and also to support the young entrepreneurs who are using digital technology to provide solutions to the most pressing development challenges. And as Graham has mentioned, our investments go from large to small. From Liquid Telecom, the largest independent fiber and cloud provider in Africa, to some of the smaller early stage startups and VC funds that you can read about in our review and you're going to hear more about later. And finally, it's no good being a thought leader if you don't learn and you don't share what you learn. And indeed, that was one of ICAI's key points when they first reported on us a couple of years ago. And I think they were right. I think we did need to do more to learn and to share, both internally and externally. And we should be judged on that. And so I was very pleased how we've taken on board their feedback and their scrutiny, how we've become more transparent, and we've made improvements to the way that we share information. And so we were very pleased that ICAI's recent review was happy with the progress that we've made. So there's an enormous amount going on at CDC, and I could talk about it all morning, but we don't have time for that, and I really do want to have the opportunity to introduce you to more of my colleagues. So let me just close by saying this. This is the last year of our current 5-year strategy cycle. And as Graham articulated and ICAI validated, this organization has made enormous progress over the last 5 years in becoming an even more focused development organization. What we do is not easy, and we are not perfect, and we make many mistakes. We know that we can't solve every development challenge in every country, and we don't claim that we can, and that is indeed why development finance is only a small part of the UK's overall development spending. Everything we do at CDC attracts scrutiny, as it should, and we try hard to listen and to learn from that scrutiny. But overall, as I've said before, and I want to assure you again, every single person at CDC comes to work every day because they believe in what we do, and they believe that by doing what we do well, they can make a difference. And they work enormously hard to try to do that. So most of all, I want to end with thanks. I want to thank, first of all, our board and our shareholder for their continued support in everything we do. But most of all, I want to thank the people of CDC for their extraordinary effort in what has been an extraordinary year. So thank you all. And now I have a great pleasure in introducing, as Graham said, our great new Chief Financial Officer, Carolyn Sims, who's going to walk you through our financial results. Thank you.
Morning, everyone. In 2020, CDC made £1.2 billion of new commitments. This was lower than the record level of £1.7 billion set in 2019, largely due to the COVID-19 pandemic. However, £1.2 billion of commitments is the second highest commitment level we've made since 2012, when CDC started investing directly again. This reflects the importance we placed on being a counter-cyclical investor during the pandemic, when businesses desperately needed financial support to help weather the crisis and keep the economy going, and at a time when many other investors retracted from the countries we invest in. Our investment pipeline is healthy, and we expect the pace of commitments to increase again in 2021. Total net assets increased from £6.4 billion at the end of 2019 to £6.8 billion at the end of 2020. Within this, the investment portfolio increased from £4.7 billion to £5.2 billion. The main reason for the growth in the investment portfolio was the higher pace of disbursements compared to receipts throughout the year, funding many of the commitments agreed in 2019. Our overall result is a loss after tax of £282.2 million, which compares favourably with the loss of £371.6 million in 2019, but is still a 4.4% loss on net assets. The average annual return on net assets since 2012 is a profit of £77.1 million. The portfolio generated a £173.9 million loss in 2020 compared to £268.6 million in 2019, representing a portfolio loss of 3.7%. The average annual portfolio return since 2012 is a profit of 6.1%. There are three main reasons for the losses in 2020. Firstly, foreign exchange exposure. Most of CDC's investments are in US dollars or currencies which track US dollars. Due to changes to the sterling to US dollar exchange rate over the course of 2020, the portfolio suffered translation losses. £121.8 million of the overall portfolio loss was due to foreign exchange losses. Secondly, the COVID-19 pandemic. The pandemic caused extensive disruption to businesses and economic markets globally and had a significant detrimental effect on the African and South Asian markets we invest in. This is reflected in the portfolio performance. Thirdly, and finally, CDC invests in volatile markets. The long-term shift in the portfolio since 2012 to focus on Africa and South Asia has increased financial risk in the portfolio. CDC is a long-term investor, so it's important to look across multiple years for trends. It is clear that our underlying returns continue to reduce in line with statements made in recent years. Since adopting a new highly developmental strategy in 2012, actively seeking higher risk, we did indicate that it would lead to lower returns and increased volatility in the portfolio. This has been exacerbated in 2020 by the COVID-19 pandemic. CDC is a long-term investor. We remain committed to our impact objectives, but also to achieving long-term positive investment returns. We will continue to balance our approach to achieve both aims. Now I will hand over to my colleagues who will share more information about our response to the pandemic. The first speaker is Yasemin Lamy, CDC's Deputy Chief Investment Officer and Head of Asset Allocation and Capital Strategy. But before we go to Yasemin, here is a short film about our COVID response.
The preserve pillar for me and my team at CDC has been to look at the ways in which we can support our portfolio in protecting labour force working conditions and the employment of workers, which has been obviously something that has come under an enormous amount of stress during the COVID pandemic. I think a particularly interesting example of how we have supported the preserve pillar is the work we've been doing with a range of our Indian portfolio, principally financial institutions, but other companies as well, around mental health and welfare for employees, to support really quite large workforces who have now been under difficult working conditions for well over a year.
I think the year 2020 was indeed a very, very challenging year for all of us, for the entire mankind, for economies all over the world, businesses globally, and India is no different. As an impact investor and DFI, CDC committed to providing support to us during these challenging times. We are indeed very grateful to CDC for their partnership and continued support that has helped us in translating our vision into reality.
The Strengthen Pillar was constructed as part of our COVID response framework to think about the opportunities that could arise to really augment the response to the crisis in the countries where we would invest. In practice, this involved digging through the entirety of CDC's existing portfolio for relationships with companies that could deliver some kind of response, whether they were manufacturing companies that might start to create PPE, or health services companies, or even grocery delivery companies that we had in our portfolio. So just initiating conversations with all those types of institutions to see whether there was something CDC could do to support their response. Further, we also engaged with co-investors in the market to see whether there were opportunities arising to help create new response vehicles to deliver investment into the markets.
CDC has been in the forefront of helping MCF during this pandemic. I don't know what we would have done without them. They have helped us. We have developed Safe Care for COVID app. It's a digital app which we're able to send to our clients to know if they are struggling with clinical qualities or financials, if they need investments. And CDC was there or supported us in that, which was really helpful.
Good afternoon, everyone. As you've just seen, CDC's response to COVID was laser focused on helping our partners weather the storm. Let's go back in time to the beginning of the crisis. When COVID hit in early 2020, CDC, like many other organizations, shifted our operations to ensure continuity and safety for staff and partners. From afar, teams worked together to reprioritize investment activity towards a crisis response, reaching out to partners in our market to identify how we could help. As an impact investor, we knew our response had to be wider than just capital. Teams from across our impact group and investment teams worked tirelessly to deliver guidance and support to our investees to help them keep their businesses running and their staff safe. My colleague Liz Lloyd will go on to speak more on this. From the outset, we identified 3 areas of focus as our investment priorities: preserve, strengthen, and rebuild. First, preserve. This focused on supporting the 1,200 companies in our portfolio to safeguard their impact, maintain their value, and weather the crisis. We knew that by supporting them, they in turn could continue to support their employees, a total of more than 950,000 people across the portfolio. Second, strengthen. This focused on how we could extend our activity beyond our existing portfolio to support the private sector response to the economic and health crisis. Our experience of assisting businesses and markets through the Ebola crisis meant we knew the types of opportunities that would make a difference during this pandemic, such as working with local banks to provide essential liquidity that businesses would need to keep going. Or investment in companies that improve access to healthcare and basic services. Third and finally, rebuild. From the start, we were not naive about the challenges the crisis would present and for how long its impact would be felt. We knew that we and other development finance institutions would have a critical role to play in the rebuilding process. CDC remains wholly committed to our markets as a long-term partner, standing firm with our portfolio companies through the pandemic and beyond to recovery and growth. In a very difficult year, we maintained our role as a counter-cyclical investor. In total, we invested £1.22 billion across these three pillars in a way that delivered clear and positive impact. Our portfolio showed resilience against the crisis, and Preserve pillar required less capital than we had anticipated. However, companies required intense portfolio support beyond capital, and this required an enormous amount of dedication and perseverance from all our teams. Through the Strengthen pillar, we found opportunities to deliver systemic liquidity with speed, scale, and simplicity. I am particularly proud of the way CDC was innovative in its use of tried and tested tools like trade finance to powerful effect. We joined with 4 partners to supplement existing trade finance facilities with innovative adaptations. This enabled CDC to take on a higher share of the risk to reach priority sectors and countries as part of COVID response. By the end of the year, the specialized facilities totaled £305 million. These were balanced with more targeted vehicles to deliver support to vulnerable communities in urgent need. Our existing relationship with fund manager Blue Orchard meant that we were confident in making an anchor investment of £23 million to its COVID Emerging and Frontier MSME Support Fund to reach microfinance institutions and financial institutions serving small businesses across Africa and Asia. We assisted in structuring the fund so it can provide critical access to financial services for low-income and vulnerable populations across our markets, and necessary value add to enhance the impact of the capital. I am particularly proud of the fact that the fund is expected to reach over 60% rural and female borrowers, who we know are often the least likely to be given access to capital. You already heard from Nick about MedAccess and M-Pharma. There are incredible stories across the portfolio of our COVID response from our investments, and much of our response went beyond capital. I'll now pass to Liz Lloyd, who will share some of that powerful work.
Thank you, and good morning and good afternoon. For many years now, we have operated our technical assistance facility, CDC Plus, which provides support to investee companies and the wider market to deepen impact. In 2020, CDC Plus, working with FCDO, launched 2 initiatives, the Business Response Facility and the Emergency Technical Assistance Facility. The Business Response Facility was designed to support our investees in adapting or scaling up as they responded to the pandemic. And the Emergency Technical Assistance Facility provided guidance and advice on companies on how to respond to the crisis. CDC Plus approved £5.2 million for 65 projects to provide direct support to 84 businesses in our portfolio and affected over 4 million people in the countries we invest in, providing improved access to healthcare, basic goods and services, and helping businesses adapt to the pandemic environment. A fine example of how we shaped our COVID response through the use of TA is our Worker Protection Facility. We know that throughout the world, COVID affected workers either directly through uncertainty about employment, concerns about health and safety at work, to keep safe from COVID infections and impact on mental health, as we heard earlier. In total, this facility has benefited 26 of our portfolio companies, which employs 75,000 people across Africa and South Asia. On workforce planning, for example, we work with companies on workforce implications of the pandemic, including revising HR policies, understanding worker needs, and moving the workforce to remote working. And we made sure to share knowledge as swiftly and widely as possible, drawing on our expertise to provide bespoke advice and guidance and beyond to the public on issues ranging from job protection, customer protection, remote working, and returning to work. In all of this, it should be noted we did not lose sight of climate as well as gender and inclusion imperatives. The crisis focused attention on the importance of responding to the threat of climate change. And since launching our climate change strategy last year, we've shown leadership alongside other DFIs by making commitments to ensure our portfolio reaches net zero by 2050, supporting a just transition to a low carbon economy, and strengthening resilience in our markets to the effects of climate change. I'd like to highlight that working with others, we're working to produce finance roadmaps for just transition in India and South Africa, again financed by CDC Plus, to show what needs to be done to enable development and a just transition for fossil fuel dependent communities. We've also continued to sharpen our approach to gender smart investing through the crisis. You'll hear more about this in the sessions to come. I'd like to hand over now to my colleague, Tenbite Ermias, to hear a view from Africa.
Thank you very much, Liz, and good morning and good afternoon, everyone. I will give you a quick update from Africa, from Nairobi, which is where I'm sitting right now. As everywhere else, 2020 was a difficult year for Africa, with COVID impacting lives and livelihoods on an unprecedented scale. Health-wise, in 2020, Africa had at least 3 million confirmed COVID cases and 100,000 deaths. Given the low levels of testing, the expectation is that the actual numbers may be 2 to 3 times as much. Vaccine rollout was slow in 2020, and even now, in the middle of 2021, less than 2% of the continent's population has received even one dose. Several countries are also going through third waves right now, and it's clear that the pandemic will be here for at least 6, 12, maybe even 18 more months. COVID has also set the continent back several years, as has been mentioned, in terms of development progress. The IMF estimates that 40 million jobs were lost in Africa last year, and that 30 million people may have been thrown into extreme poverty. The sectors that were hit hardest economically, retail, hospitality, tourism, also tend to employ women and the poorest, which has increased inequality on the continent. Worryingly, disruption to education has also jeopardized the prospects of a generation already facing job-starved futures. Now, within that difficult context, the impact of COVID in 2020 on CDC's African investees was mixed last year, in a manner that is not dissimilar to the rest of the world. Generally, businesses with integrated value chains and strong cash discipline, we saw, had the ability to weather the storm better. On the other hand, businesses that were serving cross-border markets and exports, either within or outside of Africa, struggled as well because of border controls and difficulty transporting goods. Sector-wise, those that provide digital connectivity, liquid telecoms was mentioned earlier, basic infrastructure, everything from power to warehousing, and food products that were sold locally did quite well within our portfolio. On the other hand, our investments that related to real estate and hospitality, for example, our commercial and industrial rooftop solar investments were more challenged last year. Importantly, CDC was a meaningfully counter-cyclical investor in Africa in 2020. In a year when Africa's foreign direct investment declined by 20%, as Graham mentioned, CDC committed over $1 billion of new investments in Africa. And as mentioned previously by Yasemin, the $300 million that we provided for supply chain and trade finance through our banking partners ensured that businesses could import vital equipment and goods, including staples for many of the African countries during the pandemic. We also made several direct investments on the continent that I think had great impact. 2 examples I'm particularly proud of would be our investment in Equity Bank here in Kenya, which is providing much needed capital to entrepreneurs and SMEs in the country, and our commitment, along with our DFI and our fund partners, to a continent-wide pharmaceutical platform that will deliver affordable and life-saving treatments across the continent. I'm also proud of our CDC's team that is growing on the continent. We now have 4 offices. We are located in 6 different countries and nearly have 25 coverage, investment, and impact staff on the ground. Nick mentioned that our local presence has been especially important during this year, during the pandemic. It has allowed us to originate investments, to support our colleagues in London on due diligences, and to support our portfolio management efforts in the various companies that we have capital deployed in on the ground, at a time when travel from London has been very difficult. Last but not least, 2020 saw an acceleration in our engagement with partners in country. We have had very strong collaboration with our HMG colleagues, particularly with FCDO, but also with other HMG teams in countries like Ethiopia, Ghana, Nigeria, Egypt, and we continue to build on these across more countries. We've also been working quite closely with our fellow DFIs in country, particularly on issues that are relevant to all of us around policy, regulatory aspects. And we've also worked quite closely with local government and media, which is a step forward for us in terms of our local presence. Now, over the coming year, we look forward to building on the successes that I just outlined in Africa, and also the lessons that this difficult year and this memorable year has taught all of us. And we will continue to focus on our goal, which is to support the African sector through the recovery period and beyond. Now, with that, I'll hand it over to my colleague Srini to talk to us about South Asia. Srini?
Thank you. Thank you, Tenbite. Good morning, good afternoon, and to everyone, and thanks for the opportunity. As you see, the COVID-19 cases having declined by around 75% from the early May peak in India, and the vaccination crosses around 350 million. 2 things are very clear as I sit here in the region. The last phase of the pandemic will be a bit long drawn out, and 2, it'll leave behind a very different world. In the whole continent here, patients have nearly paid 70% of healthcare expenses themselves. The COVID has really surged, has forced millions of families to tap into their savings, sell assets, or borrow to treat ailing families. In addition, SME sector, which is very critical for these countries, is going through enormous stress and job losses. If you look at the Western countries, they have paid 90 cents for a dollar for every lost output. And it's been tough for the South Asian economies to stretch the balance sheet, and the rating downgrade, of course, is an issue. So there are 2 shifts here: a growth in state power and oligopolies, and a different radical shift amongst people is an overturning of everyday life leads to a search for meaning. So within the region, Myanmar has faced uncertain outlook due to the political instability following a military coup, and unrest and violence triggered major disruptions in the country. Amidst this gloom, there are a few brighter spots. The digitization, as the earlier speakers mentioned, has managed to leave its mark. If you look at the internet customer base of 600 million in India and 100 million active users, the level of digitization has gone multifold with the onset of COVID, and the internet users have got terribly habituated with transacting online. Technology is disrupting across all the core sectors, moving the informal to the formal segment. And it's eliminating the middlemen so that there are the improved realizations in the hands of producers, and thereby increasing the livelihood and reducing the cost of services to lower income segments. There's an enormous drive towards digital investments across the subcontinent, including India, Pakistan, and Bangladesh. CDC is currently working with 6 fund managers in the country and in India, and has invested $70 million, and definitely looking to have a very active co-invest program. Plus, there is an enormous scope to take these disruptive technologies to other markets in South Asia and Africa. Let me turn to climate. India, within the region, is currently generating around 95 gigawatts and set an ambition for 175 by 2025. And similarly, Pakistan and Bangladesh have got big ambitions as well. Having said, the transition from coal is a journey, and there are 3 main things in the transition: governance, people and communities, and infrastructure. I'm very proud that CDC and its accomplished climate team are continuing to play a pivotal role in this journey in our various countries. Our investment in IANA, as Graham said, which we started and now is a JV with the Government of India, continues to achieve great strides, with around 1.75 gigawatt today to around 10 gigawatt by 2025, and mobilize enormous third-party capital. ESG is a very important component. The regulators and shareholders within the region are beginning to recognize the business and the financial impact of ESG risks. It's no longer treated as a compliance issue or cost of doing business. So corporations now want to embed ESG principles in their very core business strategy, and our ESG team is playing a pivotal role. Let me say 4 or 5 highlights on the region. We have grown our presence in the region in every country. Every country has a presence, a rep office and an office, and these offices are immensely valuable under the COVID circumstances. We got a full-fledged investment support teams working seamlessly with London, and which gives us enormous ability to portfolio manage and originate the right deals for CDC. In response to our COVID-19, our healthcare portfolio really stepped up, and some of the companies like Ecom Express also offered a lot of support to the families of the COVID-19 diseased families. And we are in the final stages of providing a loan to GenWorks to supply the much needed oxygen concentrators and ventilators to tier 2, tier 3 hospitals in India, where we are likely to have a third wave. We also are providing the much needed liquidity to the MFI sector within the country. Investees like Big Basket, Ayana, Veritas, and Ecom are seeing inbound investments and an uptick in our value, which is positive news. Most importantly, increased number of jobs. The financial services portfolio, operational impact of COVID was high, and an enormous amount of time has been spent by the team in understanding the impact and supporting companies where needed. And thanks to our ENS and DI team to support us with the best practice guidance on employee safety, customer protection, etc. Our Asia funds team continues to focus on impact investing, and they're gradually moving to the region to draw a lot of synergies for us, really. And I'm proud to say that the CDC Plus and the FOMO and the Swiss agency launched a market building platform, which will support foreign direct investment into Nepal, which is very critical for the country. Finally, our legal team stepped up dramatically, working remotely with the various teams in the region, and thanks to the CIO office, who have handled enormous pressures. I just want to talk about one investment in closing, and which is very dear to my heart, our investment in WorldLink in Nepal, which now delivers internet services to the most remote province in the country called Karnali. Karnali connectivity was not an easy project. It took 2 years to try and complete, since many villages are an altitude above 4 kilometers. Through WorldLink, I'm proud to say that Karnali's 407 schools, 296 health posts, and 693 government offices are online. And Karnali Basin Conservation Foundation, a nonprofit promoting biodiversity conservation and economic development, has now collaborated with WorldLink to leapfrog into an information age. Finally, we continue to work very closely with FCDO in the region, and we are devising a new framework to deepen our relationship in the various countries. I want to end by saying that convey my sincere thanks to colleagues in the region, as some of them have lost their loved ones within a matter of weeks. And our thoughts and prayers are with the victims and the families. We are coping very hard to work with the crisis. It is during these moments we feel very proud to be a part of the CDC family. Thank you so much, and I'll pass it on to Lynsay.
Thank you, Srini, and indeed everyone, the entire team here echoes your words about the impact of COVID on our colleagues and friends over in India and elsewhere around the world right now. Thank you all to all of the presenters in that previous section. I've been at CDC now for 6 years, and I never failed to be impressed by the range and the breadth of work that we work on here at CDC. That was shown in the presentations you've just heard, and it's actually coming through in the questions that we can see coming through in the Q&A. So I've now been joined by Nick and Graham, and we'll stick with COVID. We've had a few questions come through there. The first is on the process of intermediation. How are we coping with due diligence at this time during COVID and making sure that our partners are delivering what we need them to?
Well, so I mentioned during my remarks that obviously one of the most significant elements or differences that COVID has made to an organization like CDC is that we can't travel. And that was obviously a fundamental part of our investment process, and it's of any investment process or any impact process, is to be able to go on the ground, meet people, kick the tires. So we haven't been able to do that now. Excuse me, we haven't been able to do that now for a period of about 15 months. But I have to say that I have been pleasantly surprised by how well the organization has adjusted to that. I think we didn't start rolling out our international offices because we knew there was a pandemic coming. But clearly that has been enormously helpful to us during this pandemic, having those people on the ground in India and in Africa. And we've relied heavily on them. And then we have had to use more outside consultants, more locally based consultants. Obviously, many of these people that we know very well, we've worked with many times in the past, and that we know we can trust. But I think overall, it's still suboptimal. But I do have to say that I think the organization has coped very well and continued, as we saw in Carolyn's numbers, to invest at pretty much the same pace as we were before.
Did you have to change the way you thought about deploying capital during that period when you were thinking about who to invest with?
I think we had to change. Of course, for COVID, we had to pivot, and there were the investment pipeline that existed in March of last year. A lot of it went away, so we had to pivot to look to provide more specific response to COVID. But I think overall, the disciplines, the basic disciplines that we apply to every investment, which are the basic financial disciplines to ensure that these are sustainable companies, and also the basic impact disciplines to really be sure that that these investments will actually change people's lives. I think those are largely unchanged. You just have to do them differently, and perhaps rely on somewhat different people.
Thank you. And we've heard a lot about the challenges of COVID, and one of the questions we have is, actually, do we see any opportunities for any of the businesses or the countries that we've been investing in emerging from this pandemic?
That's a difficult question. Let me take a crack at that, and then I'll let Graham take a crack at it. There are very few advantages from a global pandemic. I mean, whatever way you look at this, and certain countries have been affected more than others, certain industries have certainly been affected more than others. There's been a significant shift, as there has been in every country, towards a more of a digital economy. So, I mean, clearly from some of those companies, if you like, I suppose, have benefited in that their market opportunity has increased. But there's really been very little that you can point to and say there's an advantage here, because it's been such an enormous health and economic catastrophe, really, for the world.
And I guess digital penetration is particularly low in the markets where we invest.
Yeah, as I said in my remarks, it's reinforced the need for development finance institutions to play a much more active role in both developing digital infrastructure and also supporting at a much smaller level those entrepreneurs who are using digital technologies to create solutions to development challenges.
Yeah, I mean, I'd echo that. I mean, I think on a macro scale, you look at the kind of the move towards protectionism. That's going to be really hard. Ethiopia has been working incredibly hard to develop industrial parks. You know, what's going to happen to that in this new world? I'd say the only positive thing I'd say just would be in terms of the connectivity with our teams. Nick talked about it, how it was a great part of our response. You know, when we have, I see Exco working, we have board meetings, we're all on one screen. So we're all here, and, Srini's Tenbite, KK, our board member in India, Andrew Ali in Nigeria. So that in that sense it comes together, but the challenges ahead, we really don't think they've been appreciated.
And that, I guess that leads me on to the next question, which is about planning for the new strategy and what challenges that's raising, given that we're doing that during this particularly difficult year, and what the process looks like.
Yeah, that's a really good question. So shall I
go ahead? Yeah.
So I think, and I mentioned early on, the process for CDC strategy starts 2 years in advance. Last April, COVID happened. We really wanted to do the very best job. You've heard amazing things by the team, but we said we're going to carry on doing all the process we plan to do anyway on the strategy. So the strategy in CDC, although our investments are very long term, 10 years plus, literally, we sold one company we'd been investing in 50 years, 3 years ago. Our sense of accountability and the key driver for the shareholder to manage CDC is through the 5-year strategy period. And the process for that starts 1 year, 18 months from the end, with an external review of how have we done against the previous 5 years, and what learnings will there be. So we've basically been doing that for the last year and a half, working with FCDO and the management team, lots of great ideas, but how can we make that happen? And the board, the management, and FCDO working together. And we're now in pretty advanced stages. The first strategy cycle starting in 2012 was all about refocusing CDC on the hardest geographies of the world. The one that Nick's, was talking about today, was about catalyst. It was about gender. It was about climate change. It was about new measures of impact, all of which, the management team really have executed on. The next phase, Nick maybe will give a few words about it in the future, but that will be just as challenging. So the process has been working on, I would say, pretty much in exactly the same way in the previous cycles, and that's a credit to the FCDO team and the management team and the board.
And of course, it kicked off with quite a large engagement exercise as well, run by DFID, going out and talking to about 300 different stakeholders.
Yeah. All that's happened, and obviously learnings of COVID have been built into that process.
Nick, anything to add?
No, I think Graham covered that very well.
Great, thank you. So next question is I'll go off, and this shows the breadth. Microfinance, which was mentioned a couple of times, particularly by Graham. General question of, because there were a few questions on this, what are we doing? How is that helping us at the moment?
So I think, look, microfinance is something that has a special place for many of us in the sense that in terms of the length of our involvement. I first got involved in microfinance, or it was the first sort of impact investment activity I ever got involved in, probably 15 years ago now. Graham should talk actually about his own personal involvement for many years in microfinance. And we still believe we have CDC's been a supporter of the microfinance industry across all our geographies, really since for certainly more than 10 years. But obviously, at a time like this, in a pandemic, in a financial crisis, at a time when liquidity gets sucked away, it's a particularly profound change for microfinance institutions. And at the same time, their customers, many of whom work in the informal economy, and their ability to earn an income during a pandemic is severely restricted. So it makes it more difficult to repay their loans. So for us, I mean, microfinance in the last 15 months have been about providing support both to our existing microfinance investments, which range across all of South Asia and Africa, and also trying to find new ways to put support into that market. So for example, our Indian colleagues worked to develop a pool bond structure. I think it was the first pool bond structure, certainly the only pool bond structure that was developed specifically for microfinance over the last 15 months. We continue to support, obviously, some of those microfinance organizations that we had invested in before the pandemic. So Veritas is a really good example of a company that we invested in through the Catalyst portfolio, actually, when it was much smaller. It's been very successful, it's grown, but they needed more support during the pandemic, and we were able to transition it and graduate it from the Catalyst portfolio to the growth portfolio. We mentioned, I think Yasemin mentioned, the Blue Orchard transaction for SMEs, which was focused on largely through microfinance. So it continues to be a very important part of CDC's strategy for financial inclusion. It has been particularly challenging over the last 15 months, but I think we've done a variety of different things to really provide support for the industry.
I mean, like Nick, I was working in microfinance 15 years ago, and I think CDC, the heart of our progress has been in India. Not just now, but actually with the small bank finance program, where we played a leading role. Srini, Holger, you're going to see later on, led a lot of the transitions from not-for-profit, small-scale microfinance to regulated businesses at scale. And I think in the last 5 years, CDC has started to take that elsewhere. I visited just before lockdown up in northern Pakistan, right up in, on the border, in a very difficult area. Habib Bank's first microfinance bank that we funded, and a lot of work we're doing in Africa now. So I think CDC has been a leader within India and now expanding to other geographies with different models, because it doesn't always work.
And go from the very small to the very big. We've had a question about, it's not strictly 2020, we've recently invested in Ethiopia for the global partnership for Ethiopia for a mobile telephone license. A question about how much we've invested, what's the length of our investment, and what's our excellent plan?
Yeah. So I'll talk about the specifics, a little bit about the specifics of our investment. We did invest. We were invested alongside Vodafone, Safaricom, Vodacom, and Sumitomo in purchasing the new mobile license in Ethiopia. We were 10% of that consortium. We anticipate that in order to get the mobile business up and running in Ethiopia, it'll probably require an investment of $2 billion before you see any cash flows. So we'd expect our piece of that to be about $200 million. We invested, it's called the Partnership for Development for a reason, all right? We invested alongside Vodafone because we thought that this was probably the single most transformational thing that we could do to help Ethiopia develop. And we, the Ethiopian government have estimated this could create over 1 million jobs just in the first year of operations. We estimate that over a 10-year period, it'll probably bring 45 million people, 45 million more Ethiopians onto or provide mobile access for them. It's going to have a mobile money and the provision of mobile money, obviously working with Safaricom, who are the global leaders in mobile money, an important part of this project. And we think that, and we've seen in the past in other countries how transformational mobile money will be. We've got plans to, and obviously our role in this consortium is to, working with a very aligned partner in the Vodafone Group, but our role is really to make sure that that development is front and center in this project. So we've got plans to on how we can use the network to help improve education, how it can improve health. So we think it's got a huge potential. We know also this is not an easy time for Ethiopia, and we know we've attracted some criticism for that reason. But I think we have to look at this as a long-term investment. We have no specific exit plans. We almost never have specific exit plans. We're meant to be in these investments long-term, and we believe that, as I said, the impact case is an overwhelming one that will really transform lives in the country.
Thank you. Next question is staying on jobs. How are we supporting vocational training or helping economies to transform or companies transform and upskill their workforce?
Well, skills training is a critical element of almost every investment we make, and we do have some great, very specific examples. A lot of the investments we're making, Ayana was mentioned before, a company that we actually created in India. That has had a program, a skills development program, helping to bring more women into the company so that they can learn how to do these essential new jobs in the green economy. iMerit is another example that you'll find in the annual review of a company that is employing now 3,000 people in poor states in India, but 60% of those are women. And they're excuse me, and they're training them to work in the digital economy and in artificial intelligence. So these are really skills, new world sort of skills that we're able to use our investments for training.
And I'll move on to a slightly different topic, which is the funding cuts that have been announced recently. Obviously a difficult time for the development sector at the moment. Any reflections or thoughts on the impact of those?
Sure. I mean, look, the first one is we obviously work in the field of development, so everybody at CDC feels so much for the beneficiary and all the partner organisations that who are taking these cuts, and CDC has also had cuts. Our job as a board and a management team is to manage the funding situation we have. We have long-term fundings. At the moment, we have $2.5 billion of long-term commitments. So, as last year started, with responding to COVID and then the change in the GDP target, and then this year with the aid budget cut, we've obviously been in close discussions with our shareholder. We're going to adapt. I mean, I think the management team have done a great job. A lot of the the rationale, the adaptation earlier was to work with existing partners and providing short-term liquidity. So we built that into our program this year so we could give money, but then also hopefully receive some money back in a slightly shorter time term than normal. Because we do know that the next 10 years, it is just huge, the amount of money needed for the rebuild. So we've adapted, we'll manage with what we have. We've had cuts, we've had to reschedule things, and we have a huge amount of sympathy for all the partner organisations. But we also understand the government has, has a range of priority targets, funding targets.
Thank you. Next couple of questions are on the area of, actually, both touch on fragile states. It's an area where DFIs can really make a difference. What have we been doing in that space?
Well, so I think since 2012, really, when CDC is unique among development finance institutions in terms of our geographic remit. Every other DFI has a global remit, so they can go to any part of the globe. CDC is specifically focused on Africa and South Asia. And really, the driver for that was an ambition by the government to reach the poorest, most fragile, most conflict-affected states. And if you look at what's, if you look at the numbers, about $2.5 billion of our balance sheet is invested in fragile states. That's as at the end of last year. That's about a third of our total portfolio. We invested last year $735 million in fragile states, and these are fragile states as defined by the OECD. We believe that's the highest proportion of any development finance institution. We recognize also that there are enormous needs, development needs outside those fragile states. The circumstances are somewhat different, but there are enormous development needs outside those states. So we wouldn't expect all our money to be going to fragile and conflict states. But we think that again, relative to certainly to our peer group, we've got we're particularly well represented.
Can I just add to that as well? Because it is so hard. Our mandate's so hard. And investing in fragile states is the hardest thing of all. Nick talked about the Ethiopian investment recently. Our view is you can't have a modern functioning economy or a modern functioning democracy without a multi-provider mobile phone and data system. So that's why we've made the investment in Ethiopia. But then we also understand why we get criticized for it, given all the difficulties at the moment. But that is our job, is to take a long-term view, but investing, Paul Collier says it very neatly, investing in a fragile state is like building a cathedral, like Gaudi's cathedral, but without the scaffolding. When you build a cathedral normally, and all poor countries have developed, so rich countries have developed without seeing all the challenges that you go through, whether it's corruption, whether it's difficult governments, whatever. And our job is to find a way through that. And it causes us criticism sometimes, but that's part of the mandate.
And that's a great place to finish. Thank you. I've been told I'm afraid we're out of time for this section. So thank you to everybody who submitted questions, and I am sorry if we didn't get time to get round to yours. So that concludes the first half of our event. We're heading for a quick 5-minute break, but please don't go too far, because straight afterwards we'll have 2 excellent panels, first on people, then on planet. Those sessions will be chaired by Holger Rothenbusch, who is the head of our infrastructure and climate group, and he'll be chairing the planet session. But first up after the break will be Tony Morgan, who heads up our smart industries group. And smart industries means that's the team that looks at things like manufacturing, agriculture, real estate and technology. So he will be welcoming you back after the break. And we will see you at the very, very end to wrap up. Thank you.